What is this mode that you have for Zoom? Because I've seen that on anybody else's call.
What's that now?
You know, where you have panelists and attendees.
Oh, yeah, everybody's an attendee. I can promote them to panelists, so that we can see their video, their pictures, or if they're live video. So let me do this. We're live. We're actually recording, but we're all family here, so we're just going to relax a little bit, and I'll give him my first message of the new month. Happy Groundhog Day. Okay, so let's see who we have here. So you're already a panelist. Okay, so I'm going to go ahead and promote everybody here. Hopefully, the computer. Lower all hands. I'm not sure what the heck. I didn't know any hands were raised there. So I'm going to promote the panelists, that way we can see everybody's faces here. Melanie, Jeff, Jason, Beverly, Betty, and I think I got everybody so far. Now, there's going to be a few more. I know last week I thought I had everybody online and ready to rock and roll, and then I found out a few minutes later there's maybe 6 more that were waiting to get on board. So we'll give everybody another minute here in a second. But hey, Tom, good to see you. Yep. Hey, Beverly. I like your sweater.
Thank you, Gary. How are you?
That's nice. Yeah, look at that. A Christmas present?
No.
Okay. Hey, Betty. Good to see you, Betty. Shirley, good to see you. Hey, Betty. I think that was you, Rebecca, said that document, it wouldn't let you sign it. Send an email to me tomorrow or tonight, and I'll send it to the contract person. We'll get that squared away. So, okay. Hi, Melanie. Hope you're doing well down in beautiful Austin. Jeff, good to see you, buddy. Wow, look at that fancy background. Nice. No, not fancy. You're muted. If you can hear me, Jeff, I think you're self-muted. Jason,
it's definitely 1970s behind me.
Okay. That's okay. I got Grizzly Adams behind me. That's why I've got the background on. So, in any case, let me check and see if there's, I think that is everybody so far. Okay. So many of you probably remember Neal. He was on a few months ago, and we wanted to have him back on again because obviously it's primetime tax season, and there's a lot going on. I mean, holy smokes, everybody's probably wondering, how do I do my taxes after last year? And I'm wondering the same thing. Subjects he wants to talk about. And I thought I'd give us a lot of help because all of us are independent contractors following 1099 rules. And there's likely to be some changes there. I don't know. I'm saying I learned in the past to don't do that stuff myself. I have his name's Jerry Irby. I've been working with him for 24 years. And he's getting ready to retire because he's in I think his 80s, and his son's going to be taking over. So we'll find out. But in any case, hey, Neal, thanks again for joining us, man. I appreciate it. I know you're a busy guy, and I appreciate you sharing your valuable knowledge. I'm going to let you go. I'll keep promoting people as they sign on.
All right. Sounds like a plan.
Okay.
Yeah, so thanks for having me. It is prime time tax time. I am, I don't know, 3 weeks into preparing tax returns because a lot of my work, we have such volume that, we start even before the IRS opens. And the IRS is opening really late this year. February 12 is the number. But we're hearing from our software company that a lot of the forms that we use are not going to be available until at least the 19th. So we'll see how that goes.
Okay.
All of you guys who are independent contractors. So I don't know if this is every software vendor, but at least ours. One of the key forms that we're waiting on is actually the qualified business income form, the 8995. And so anybody who's delayed by that, will include people who have real estate as an investment or are independent contractors or have any kind of business at all. So if you guys are planning on doing your taxes soon, just be aware that that might be a delay. But what I wanted to talk to you about tonight, because David Edwards had reached out to me, and I happened to be working on a new book, so I was like, hey, that'll be great.
Cool.
And basically, it's all about real estate agents as a business, and the things, the simple things that everybody can do in order to save about $7,418 on taxes. So let me go ahead and share my screen. You disabled participant screen sharing. You can.
Oh, that's right. Okay. Let me take care of that. So Neal, okay. You should have that pop up any second now.
Ready? I got it. So let's see, share. Let me bring the window over. Dun, dun, dun. I never know where this window is going to pop up. But yeah, so the working title of the book was how you can sell $1 million in real estate without paying $1 million in taxes. But then my marketing guy got a hold of it and he said, no, it's too long. Let's just put it down, get to the point. 3 simple strategies that any real estate agent can use to save $7,418 a year. And some of this, I mean, you guys are a little bit more advanced than average, so some of this might be a little bit review, but it all works cohesively. So we'll run through it, and there'll be plenty of time for questions, comments, and everything else at the end. But I'm going to talk quickly. I have this California dreaming story. This is Jack and Diane, which is not their real names, but Jack works a day job. Diane got into real estate in 2018, and she, her first year was slow. Everything's getting started. She only had 1 closing. She made $6,000. But in her second year, she killed it. I don't know how many transactions this was, but she made $166,268 in commissions. And that's why I call it California dreaming. They're out in California, and you gotta love those house prices. It doesn't take that many transactions to get up to bigger numbers. And with strategies that we're going to go over, they saved $18,551 in taxes, which is it's higher than the number I talked about it at the beginning, just because they have higher numbers in California. So, but also keep in mind that's federal only. There's similar amounts for the states, and obviously state's going to depend on where you are. If you're in Florida, then you don't have to worry about it. If you're in Texas, you don't have to worry about it. If you're in New Jersey, Hawaii, California, New York, my apologies. There's going to be a lot of taxes. So I'm going to show you exactly how to do this and how Diane here saved money. This is us, Tech Sherpa. 40. This number is a little bit dated. We're up to about 50,000 tax returns right now. $250 million of tax payments processed. $2 million worth of client annual earnings that we work on taxes with. And here's me. One thing I didn't talk about last time was my own kind of backstory. At one point I owed $1 million to the IRS, and that was my entry into the tax world. So I ended up meeting a great former Wall Street tax attorney, and kind of went under his tutelage there. And so ended up paying $0 of that dollars, by the way, because I didn't actually owe it, but the IRS thought I did. But I've been through that whole journey where you start getting letters, then you get more strongly worded letters. Then if you still ignore them, and 70% of all notices sent out by the IRS are not responded to. But if you keep ignoring them and they think you owe a lot of money, they'll start sending you certified mail where you have to sign for it at the post office or at the door. And then they started garnishing my wages. And that really got my attention at that point, because they were leaving me, I forget the number, but it was like $250 or $300 per paycheck, which was, I couldn't pay my rent and things on that. So that was kind of a problem. But that's how I got into the tax world over a decade ago. And, I've been saving clients, $20, $30 million ever since. So there's 4 steps to this whole thing. Step 1 is you LLC. And, I like to, I use back in the late 2000s, the paycheck they were garnishing was actually when I was tutoring high school kids for SAT and stuff like that. You always have to connect something to a reason, like why do I even care about any of this? So each section has a why. And the why for you LLC is separate entity. A separate entity is job number 1 for asset and tax protection. So, Gary was talking about, getting 1099s and everything. It's like, who is that 1099 going to? Is it you as an individual? Is it your entity? So operating as a separate entity, you have 10 times less audit risk from the IRS, which is kind of what we went over last time with the tax gap and everything. The details, don't matter that much, but basically, if you're running your business as a Schedule C, which is either not incorporated at all, or it could be an LLC that's disregarded, and either way, it'll show up on your personal tax return. You have 10 times the audit risk of having your business in a separate tax entity. People ask all the time, should I be an LLC? Should I be a corporation? Should I be a PA? For tax purposes, it doesn't matter. We're going to get into that in a little bit. But different states will have different regulations. Your broker might have different requirements. So you want to check with your Secretary of State. Like in Florida, you can be an LLC just fine, but it has to be first name, last name LLC. Same like a PA structure. So it can't be Smith Real Estate LLC. It's got to be John Smith LLC. But different states have different things. Some states don't care, some brokers don't care, and some do. So just check. But again, for tax purposes, it's all the same. What about Nevada? Anytime I talk about companies, people always come back to me and says, "Well, I read this thing, or I heard this podcast, or this presentation says, oh, I should incorporate it in Nevada," and all of these companies are going to be pass-through entities for tax purposes, which means it comes home to you personally, and it's going to be in whatever state that you live in. Also, you're operating as an agent in whatever state you're operating in, and if you're operating in multiple states, then there's kind of a different consideration. But most people are just in one. So you're going to want to incorporate or organize in your home state. The people who talk about Nevada are really talking about asset protection and privacy. So Nevada, Wyoming, South Dakota, Delaware, those are all good privacy states because they don't actually list the owners of anything online. So, if that is your purpose, for entity asset protection, then Nevada's fine. But, for actually operating your business, it's really has nothing to do with it. Just as a side note, most of the people who talk about that tend to sell incorporation packages and registered agent services. So, they have their reasons. But that's it. Just, organize something, LLC, Corp, PA, whatever, it doesn't matter. And then for tax purposes, we're going to set up as an S Corp. And that will, on average, save you quite a bit of money, which we'll get into in just a second. But step 2 is profit first. So profit first is a cash flow management system. Actually, has nothing to do with taxes specifically, but you'll see later how it all kind of comes together. I'm what's called a profit first professional, which means that I help companies manage their cash flows so that the business supports you, the owner, rather than you supporting the business. Because whether it's real estate or e-commerce or any other kind of business, there's this temptation that most entrepreneurs fall victim to, which I've done myself in other businesses, is to keep reinvesting, keep putting money into the business. Something's not working, so I need to take out a line of credit or a credit card or something and put money into the business. And that is what we call entrepreneurial poverty. So we want to make sure that your business, the commissions that are coming in are supporting you rather than the other way around. And the why here is it's not how much you make, it's how much you keep. Because, I see thousands of people's, financials throughout the year, and it's literally always the same thing. So let's say somebody comes in with a W-2 and we say, okay, you made $5,000 more than last year. The response is always the same. And it's always, where is it? Because if you're not intentional about your cash flow, it just kind of floats away and disappears. So it's not how much you make, it's how much you keep. Cash flow management, we already talked about. So the basics of Profit First is organizing your business finances into 5 accounts. And this is not like accounts inside your bookkeeping, if you're familiar with that. These are actual 5 different bank accounts. And here's how it looks for the average real estate agent. So commissions comes in at the top. That's all money comes into that commissions account. And then you start spreading out money on allocations. And there's 4 places to spread it out to. One is profit. One is owner's comp. Actually, these are reversed. You're seeing live editing. All right. So profit is 5%, and owner's comp is 50%. So, and this applies to basically up to 250,000 in revenue. Once you get above that, the ratios change a little bit. But so 5% to profit, and that comes first because profit is first. Whatever we emphasize is what we do. So 5% to profit, 50% to owner's compensation. That's take-home money. Part of the deal with an S corporation is that you have to take a reasonable salary. Reasonable's in quotes. That's not defined anywhere in the code, but basically, if you had to hire somebody, what would it cost? 15% goes into a tax savings account. Doesn't have to actually be a savings account, it could be checking, but it's just a tax account, and you let money pile up there, and 30% is OpEx. So operational expenses. So one of the things about real estate is that it's very service heavy and not so much fixed expense. So you very well might find that you are not actually using 30% of your commissions in operations expense, and then the surplus there is what I like to focus on for growth, and that can be lots of different things. It could be expanding your team. It could be developing new marketing channels. It could be continuing education. It could be maybe just investing in real estate, as a separate line. But regardless, that's the money you have to work with. And the reason Profit First works is because when you separate everything out into actual different bank accounts, when you pull up on your phone and you look at your bank balances, you say, oh, I have this much in spending money. That's your OpEx account. And if that number is low, then that's a problem, right? So it helps remove that temptation to dig into your profits and your owner's compensation and your tax accounts in order to fund what are ultimately not profitable for your business. But the last element of the Profit First is never steal the peas. So this is actually a line from Nelson Nash in his book, Becoming Your Own Banker, where he has this whole analogy about if you own a grocery store. So let's pretend you have a grocery store. Goods come in the back, from the trucks. You put them out on the shelves. People come in, they buy, and do whatever. You have to buy groceries too, obviously. So where you're going to shop, obviously, you're going to shop at your own store, because why would you do anything else? So when you pick that can of peas off the shelf, the question is, where are you going to take that? Are you going to take it up front to the cashier, or are you going to take it out the back and steal the peas? And the first instinct of a lot of people is like, well, it's my peas anyway, it doesn't matter, so I'll just take it and not go through the cashier. But what you're doing in that is that you're undermining the systems of your business. So similarly in Profit First here, the temptation, owner's comp that money is not going to be sticking around for too long, because you're going to be drawing that out of salary. Profit is going to build up over time, and you're going to take that once a quarter. Tax is going to build up over the year, and you're going to use that to pay your taxes, because you'll end up, the business will pay your taxes instead of you paying your taxes. That's what that's for. But so these are both piles of money, and you just have to make sure that you are following through your discipline enough in order to not steal your own peas. And then phase 3 of the whole thing is running your business like a business. I love this little angry Lego guy. It just cracks me up.
Hey, Neal.
Yeah.
Yeah, sorry, I have a question for Melanie. The question is, what is the difference between a 5% profit account and the owner's comp account?
That's a good question. So owner's comp is going to be your actual wages. So when you're structured as an S corporation, you have to take that reasonable compensation, and that means payroll taxes fundamentally. So, you know, you're going to be paying Social Security and Medicare on the owner's compensation amounts. So, and that adds up to 15.3%. Profit distributions from an S corporation. So the way S corporations work is that it files its own tax return. Your salary out of it is an expense to that company. So it's a minus on the company side and it's a plus on your personal side. The only difference though is the payroll tax in between. So the profit though, whatever number is at the bottom of that company tax return, that number flows through onto your personal tax return with no payroll tax implications. So you do pay income tax on it, but you don't pay the payroll. So the profit there is basically your net profit after all expenses, and is yours to do with whatever you want. You're not going to be paying payroll tax on it. The income tax is going to be covered by the tax account. So this is money free and clear. So this is free cash flow for you to do with whatever you want. You know, go out and celebrate. Go invest in a new property. Go do something. Just do something fun with it. You know. So that's the difference between those two accounts. And like, you know, if you didn't have that payroll issue, then we would kind of just lump it all together. But basically, you want to be focusing on living off of the owner's compensation, and then profit is extra. All right, so running your business like a business. And the why is you need a map. And, you know, you need to know where you are and you need to know where you're going in order to get from here to there. And that's true of, you know, going down the street. It's true of traveling across the country. It's true of bringing your business from wherever it is to the next level. And so you have to kind of do your stuff in a more professional kind of way. So this is all very normal things in, like, if you go to B school, if you go to business school, but most of us small entrepreneurs didn't do that. We, you know, have a million different backgrounds, but almost none of them go through, you know, MBA programs. So this is a little bit of that more academic training kind of applying to the everyday person. So you got to know where you are, and that means doing your books, which nobody likes to do, but it gives you the knowledge of what is the current status right now. So that's where you start. You got to be doing your payroll. You know, that's actually fairly easy if you do profit first, because you just take it out of the owner's compensation account. And a 1025 cycle. So this is another profit first element where it's, you know, you don't want to be too reactive to things. So, you know, bills come in, you know, you want to be doing your books, doing your payroll on a twice a month, typically, cycle. And, you know, 1025 is just a good one to have. It could be, you know, 1429 or whatever, but, you know, twice a month, you run your payroll. Twice a month, you update your books. Twice a month, you kind of review what's going on in all of your accounts. So that gives you the picture of where you are and where you've been. But then you need to know where you're going. And this is where you're kind of going to be your own CFO. So the commissions account, is it growing? Is it shrinking? Is it zero? If it's zero, stop everything else and go out and do something. Get a house sold. If it's shrinking, this is a wake-up call. So, you know, why aren't transactions coming through the door? Is marketing broken? Is you know, are closings falling through because of some external issue? Like, is there a pandemic going on? You know, things like that. If it's going up, great. Why? You know, whatever's working, you want to, you know, increase. So, you know, these are very a quick and easy way in order to accomplish these kind of high-level financial approaches. And oops, what happened there? Okay, OpEx. So your OpEx account is your spending account. Are you hitting the wall? That's what this little arrow is supposed to be. You know, are you going down to zero? If so, you know, if you're looking at this every, you know, twice a month or every 2 weeks, whatever it is, then you have time to look at that and adjust, because, you know, running business costs money. If you're an agent, you're going to have advertising, you're going to have your subscriptions, you're going to have, you know, your MLS dues, you're going to have your super keys, you're going to have, you know, if you're paying staging people or photographers or whatever it is, there's no end to expenses. But you want to be doing it, paying for things in such a way that you are not hitting the wall every 2 weeks or every month. And, by checking in frequently, it keeps you on top of that. So that's gives you an idea of how things are going. And then you want to compare these trends, in the commissions and in the OpEx, and see, is that going to get you to where you want to go? And then this all comes together with phase 4 here, which is tax planning, or how to have your cake and eat it too. So if you remember, there was that tax account, which we're allocating 15% to. We want to keep as much of that as possible. And that's where the tax planning strategies come in, so that that'll end up being extra profit for you at the end of the year. So it's not how much you make, it's how much you keep. So keep it. And these are what I put together here, was 3 strategies that anybody can do. Basically, every business of this type can make work. So that's 3 strategies for everybody. So one is the S corp, which is its own tax strategy because of that payroll tax savings. So as opposed to operating on a Schedule C or a disregarded LLC or as a partnership, you are going to be saving, average numbers, $27.54 in self-employment tax. Strategy number 2 is the Augusta. And this is my absolute favorite strategy because it's so ridiculous. So, I'm in Atlanta, Georgia. About 2 hours down the road is Augusta, Georgia. At Augusta, there is the Masters Golf Tournament. I don't know if you've heard of this. There's always an uproar every year because they don't allow women. Actually, I think they might have changed that. I'm not sure. But anyway, so a bunch of rich guys who live around this super nice golf course decided that they wanted to rent out their houses during the golf tournament and not pay taxes on it. So that's now law. It's Section 280A of the Internal Revenue Code, and you can look it up on Cornell's law site if you want. But basically, the way this works is that if you rent out your primary residence for 14 days or less non-consecutively throughout the year, you don't have to declare the income at all. So it's not even like it's tax-free. It's just like it's magically gone for IRS purposes. So we're going to take advantage of that. And we're going to have some corporate meetings at your house from your S corporation. Now, this is a strategy where you have to have a separate entity in order to make this work. You can't do it with yourself. So what we do is we look at comparable market analysis, just like any other kind of real estate thing, and but the comps here are other corporate meeting event spaces. So you can look at golf courses, you can look at marinas, you can look at hotel ballrooms, and you get a quote from them, and you say, okay, I need tables, I need chairs, I need the AV set up, I need the beverage service in the back of the room. I'm sure all of you have been to some kind of event like that at a hotel ballroom or something similar, and they get expensive. So even for a small room, you're talking about on average $1,000 a day in rental expense. And so that's kind of the nationwide average. It's going to depend, it's going to vary depending on your particular location. Some places are higher rent than others, but 1,000 is a good kind of ballpark area to start with. And so on average, that's going to save you $24.64 in tax. And these numbers right here are not deductions. These are like dollars in your pocket after tax savings. So this is money that we'll be able to take out of our tax account. And then the accountable plan. So the accountable plan it's an IRS approved form of reimbursements. So a lot of people spend a lot of money on things personally that are actually business expenses. So the most common one is the cars. So real estate agents drive everywhere, and there's the usual rules about you got to keep mileage logs and all that kind of stuff, but you want to have the correct way to reimburse yourself from your company to yourself personally for those expenses. Same thing with the home office. So last time I was on, I talked about a lot of the problems with home offices on your personal tax return. But if you take those same expenses and put it through your accountable plan to your company and reimburse yourself, then that's all, you're not waving that red flag for the IRS. And similar things, with insurance and utilities and your phones and everything, your cable internet. So, on average, that's going to be a $10,000 deduction, and that's $2,200 in your pocket. And then, so those three add up to 7418, and that's the 7418 I kind of promised you in the beginning. But wait, there's more. So this one is not for everybody because it depends on your family situation. But the bonus is hire the kids. And this is a great strategy. This is next to the Augusta. Hiring your kids is my next favorite tax strategy. And the way this one works is fairly straightforward. So anybody who earns less than 12,600-ish dollars a year, it changes a little bit every year. Anybody who earns that amount or less pays zero income tax just because of the way the standard deduction works. And on top of that, if you have a correctly set up entity, which is actually going to be a separate one from the S Corp here, where it's parents employing their own children who are between the ages of 7 and 17 inclusive, then you don't have to pay payroll taxes either. So you could pay your 16-year-old, 12 grand a year, and they pay $0 in tax of any tax, income tax, Social Security tax, Medicare tax, unemployment tax. It's all zero. And depending on how old your kid is, they're obviously capable of doing different things. And, how many kids you have, we're talking about a tax savings of about, 1,700 to 8 grand, basically. And here's my life pro tip. It's always the paperwork. So, very, very rarely does the IRS ever get anybody on like true fraud. So, like Wesley Snipes went to jail for a year or two, and he was doing crazy stuff with, offshore tax shelters and stuff. And he probably knew what he was doing was wrong. So they sent him to jail. They also like to send a message, not even celebrities are safe. But everybody else, they sent out these letters, and you may have gotten one, you may have not. A lot of people will over the course of their lifetime, and really they're just spot checking you. They'll say, "Oh, you have mileage, expenses as a real estate agent. Show us your mileage logs," or they'll have, or they'll question, one thing or another. It's always, always, always about the paperwork. So when you're doing these kinds of things, so like S Corp, it's either done or it's not because you have to file an actual form with the IRS. The Augusta plan, the accountable plan, these are internal documents that you need to have in your business files and executed, properly, showing that there is actually a rental agreement between, Joe Smith LLC and Joe Smith as the property owner. And, Joe Smith LLC has to have, an accountable plan document that conforms to IRS guidelines, and you have to have those logs showing, this is a reimbursement because of XYZ was a business purpose. So, that's really the key to making everything work. And, not just these strategies, but any other tax strategy as well. So those are the 4 steps. And so, you need the separate entity in order to make most of these tax strategies work. You set up the profit first, it makes the bookkeeping easy, and it keeps your business, growing into the future. You run your business like a business in order to, one, it integrates with the Augusta strategy because you're having these monthly review meetings. Oh, by the way, you can take those 2 extra ones and take a little corporate retreat somewhere. And keeps you on track for developing your business. And then the actual tax savings, all come together at the end here. So that's kind of the basic idea. And obviously, how we can help. We can help you with any of this at any stage: formation, management, doing the books. And I know people have questions because there's always questions. But I have the answer to all of your tax questions. And
Okay.
it depends.
Hey, if you wouldn't mind, would you mind briefly reviewing the accountable one again, the third one? I'm clear on the first two. We had a question on the third one. So
yeah. So the accountable plan is a reimbursement policy from your company to you personally. So most people are pretty familiar with I drove my personal car for business purposes, that kind of thing. So it's that type of thing. But we'll use it a lot in the with the car. So one thing that's interesting about the car is that you'll take actual expenses on an S Corp where you could take mileage on a personal tax return.
yeah.
So you like your gas expense, your car payments, your insurance, maintenance, and all that kind of stuff. And then you prorate it out, based on how much is personal mileage versus business mileage. Other things though is all your home office stuff. So a portion of your rent or your mortgage interest or utilities, real estate taxes. Utilities is actually a bigger one than most people realize. So you can have, you have all your regular house utilities, but a lot of people forget about the internet actually. And depending on where you are, I mean, some people are spending like $200 a month on their internet cable package, and we roll that all in. So the 2,200 comes from just an average across many clients. They get about a $10,000 kicker out of it on top of whatever they were already doing. So does that make sense?
Yeah, that helps a lot. Because I used to do mileage, but now I use have used an S corp for years.
Mhm.
And I remember my accountant saying, just keep receipts on everything,
Yeah.
gas, repairs, the whole nine yards. So
Yep.
I did, and it definitely paid off.
Yep.
So
Absolutely.
yeah.
So
Yes.
a word about receipts, because people always have this question. The technical field audit guideline is that you don't need a receipt for anything under $75. If you were to get audited and you were to get somebody who's just a giant pain, you'll still need receipts. So just keep them, file them. I mean, so many things are electronic now that it's just it's an email that you had, so that's pretty easy. But some auditors will actually not accept like a credit card statement as a proof of whatever it was.
Mhm.
So there's a little bit of a variation there depending on the particular person you get. But if you have the receipts, then you're bulletproof.
Okay. In the Augusta plan,
Uh-huh.
the house has to be your own personal home. Like
Yes.
it can't be in an LLC.
No, it's got to be your personal residence.
Gotcha. Okay. I like that one though, because heck, you could have a meeting once a month, like you were saying, and there's 12 days right there.
Yep, absolutely.
Yep.
And
Okay.
then you take another. I have some clients who will do like one day in the summer, one day in the fall, to get the 14, or some will just take like a weekend and make it a little retreat.
Yeah. It's ironic too that the 7,000 and some change, that's still a nice vacation for a small family.
That is.
And if you do that right, maybe that's a write-off too. I don't know.
Yeah, I mean that's another retreat, corporate retreat. As long as you
There
talk.
you go.
There are some fun rules with those kind of events and business days. So like if you have a meeting on a Friday and you have a meeting on a Monday, then the whole weekend counts.
Yeah. Okay.
Like that.
Cool. Okay. We have a question from Shirley. She says, is it better to have your car as a company car? And I think what she means, and Shirley, you can correct me if I'm wrong. I have a friend who owns a big plumbing company in Delaware, and it's an S corp, but he has the company buy the vehicles. You know what I mean? Instead of him personally buy it and turning everything in. I don't know which is better, but Shirley, is that what you're referring to? If you,
Yes.
Gotcha. Okay. Thanks.
Yes.
Yeah, so it's well, it's going to depend, like I said. But if it's a personal like use vehicle, like a regular car, you're going to be better off buying it 99% of the time. You're going to be better off buying it in your personal name. One, because financing through a company is a giant pain. Two is that your insurance will be higher, and three is that you actually, if you have the cars titled in the company name, then most states will assess you a personal property tax on top of whatever you pay, for your registration stuff. So like I actually had a client in Virginia. This happened to this past year, where he was running a non-emergency medical transportation company, where people who wanted to go to the hospital but didn't need an ambulance, they could call him and he could take them to the hospital. So he had titled his vehicles in his company name. But this is before we started working together. And then all of a sudden he starts getting notices from the county, and this tends to be a county issue, actually, not a state issue. And they said, "Oh, you owe us $1,000 of personal property tax." And he says, well, "What are you talking about?" And it's because he titled the cars in the company name. So if you have a plumbing company where you have a van, it's got the logo and it's only used for for company purposes, then yeah, do it in the company. You might get some fleet credit or some other kind of structure. But if it's a regular car, you're almost always going to be better off buying it personally and then getting reimbursements.
Cool. Okay.
I have a quick question.
Yep.
So, your numbers for the savings of unemployment, not unemployment, of Social Security tax seem kind of low. Because isn't it like 15%? And if you're going to be putting, say, half of your income as a distribution, wouldn't it be a lot higher than a couple $1,000?
Yeah, it's 15.3%, but it's 15.3% of 5%, not 50. So the 50% you are paying payroll tax on, because that's your reasonable compensation.
Right. So let's say you have 100K of income,
Mhm.
50,000 goes through as a distribution, and 50,000 goes through as payroll. Well, you
No.
save 50,000 on 15%, no?
No, it's so if you have 100,000 commissions coming in, you'd be taking profit on 5,000, and then it would be 15.3% of that.
I'm not following you. Sorry. Why
Okay.
5%?
So the breakouts are for standard profit first.
Go ahead and go back to the slide, Neil. Yeah, if you could.
Yeah.
See, Tom, what he was doing, he was using his example, he was saying profit was 5%, owner comp 50%, operating
Okay,
expenses.
no, I'm saying profit is 100K. Let's say you made 150.
Oh. Yeah, so it all scales based on the gross income. So if your gross income is 250, then 5% of 250 is whatever it is, 15,000, right? Let's see, 250 times 0.05. I had a professor in college who said math should never be done in public. But yeah, so if you have 250, 5% of this 12.5 times 0.153 is going to be 1912. So that's going to be the tax savings on that amount. It's going to depend on your actual numbers. So the owner's compensation portion, the 50%, you are paying payroll tax on that, because that's going to be through your payroll and your reasonable compensation requirement from the IRS. Because the IRS is well aware that there's a huge incentive. There's a 15.3% incentive to put it through distributions rather than through your payroll. So they have that rule in place so that they get something out of you, basically.
Yeah.
Hey, Neil, I've got a hypothetical question for you. I have a private consulting client.
Mhm.
He owns 8 restaurants, and he's a big investor.
Mhm.
And he knows, and most people here already know this because I've mentioned this before. A lot of how I pay myself is royalties, intellectual property, use of my name, use of my image.
Yep.
But that's because I've created training programs and written books, all that kind of stuff. So that's legitimate.
Yep.
What he wants to do is, he said, Gary, what if I wrote a book? I have a company corporation that owns the 8 restaurants. The corporation pays him, salary, obviously, but also he could be compensated in salary and also in like royalty, because he's an expert. He wrote a book, and the company pays him to consult with the company, not just pay him a salary. And I said, I don't know the answer, but we can certainly find out.
Yeah.
And because I believe royalties and all that stuff, that's sort of like passive income, the way it's taxed. You don't have to pay FICA and all that. But in his case, I told him I don't know, I'm not a tax accountant, but I think I'd be nervous about shifting too much over into royalty, because basically he built the restaurants himself. He just has a corporation running now. So I don't know if, in your opinion, would that be something he can maybe take a small portion and pay himself a royalty and reduce his income tax and reduce his salary, which will reduce FICA tax?
Yeah, so royalties are interesting. They actually appear on the same schedule. It's the E1 as rental real estate. So yeah, if he's paying for consulting, that's not going to go through a royalty. That's going to be an ordinary income event. But if it's like he has this restaurant and then he puts his name on it because like it had some other name, but then he licenses his name from himself, then that would be a royalty, and he could shift some of the income that way. But yeah, you'd have to look at the whenever you're doing the tax question, in some of these more advanced kind of things, you're always wondering to yourself, is the savings worth the potential audit? And if I had an audit, would I win? So I mean, if he's taking, let's just make up numbers. Let's say the restaurant is grossing $1 million a year, and he's taking home 100 grand in salary. Would it make sense to license his name for 500 grand? Probably not. But a small portion, 20 grand, maybe. If he's got something to back it up, where he's got some books and he's got some speaking engagements and has some value to his name. Fun twist on that though is that those kind of royalties you don't get your qualified business income deduction on, which is a 20% break on your pass-through business profits. So that could complicate the math a little bit, but
Okay.
it would depend on the situation.
Well, what's interesting is he named the restaurants after his son Emilio,
Mhm.
who's I think 13 years old. And I told him, bring him into the coaching. I'll teach him like I'm teaching you, and we'll make him a millionaire by the time he's 18. So, so Emilio could then, I guess as a minor, they could say he's using his name, right?
Well, so okay, that's actually very interesting, because then you can start to apply your kid payment strategies, because they could pay him 12 grand and Emilio has to pay 0.
Yeah. Okay. Cool. We got off on a tangent there. I apologize, but it's just
No worries.
when you have someone like you on board, I'd like to take full advantage of it.
Absolutely.
Yeah.
And just I'll just put up the slide again. So I made this link. If anybody wants to chat, I mean, these are all generalities that we're talking about. If you want to talk about your specific situation, I made a little, it's a calendar link. It's chat exp on tinyurl.com, and it'll just take you to my calendar, and you can we can talk in detail about your situation, because there's the whole financial advisor disclaimer spiel. It's like, I'm not your financial advisor, so it's same kind of things apply here. The thing about the real challenge of putting this material together was figuring out which of these 3 things applies to everybody, and these 3 will, and the kids will apply to 60%. Can I put my calendar link there? Sure, I can put my calendar link there. Just if I can actually copy and paste, that'd be great. There you go. And then yeah, I mean, it is tax time, so I am pretty busy, but I do have some openings. But yeah, I mean, we got a few minutes left. I'd be happy to answer any other random tangents or anything.
Okay.
One of my favorite things about the tax business is that it touches everything. So I see like a lot, which is pretty entertaining for me.
Yeah. Well, let's see. We got some coming in here. Let me check the chat box. Can you put his link up? There's a link. Oh, Cindy's just saying thank you. Thanks, Cindy. Hey guys, we got a few more minutes. If you got questions, boy, I tell you what. Normally this kind of stuff costs you money.
That's true.
Yeah. So oh, by the way, the book. Can you tell us? Is the book ready, or where can we get the book?
It's not ready yet. This is very, very sneak preview. I'm actually working on 2 books that I think you'll be interested in. So one is going over all this and going way more into detail about how to build an Augusta plan, how to do your market research, and all that kind of stuff. But the other book is actually a tentative title is I'm totally blanking now, but it's
top secret.
Yeah. How to make millions in real estate and never pay a dime in taxes, or something like that.
Oh, cool.
And that's not as an agent though. That's as a real estate investor.
Okay.
And real estate investor, if you're a buy and hold kind of person, there's all kinds of fun games you can play, because that's very advantaged from the IRS standpoint. So I know a lot of you guys do both. I'll give you the 2-minute version of that thing. Is so 1, buy real estate investment property. Step 2 is do cost segregation to accelerate your depreciation. 3 is when you use that up, 1031 into something new and do it all over again. And you can just roll it over and over and over again. The depreciation, which you accelerate through the cost segregation, protects your actual cash flow income from taxes. And then you just have no capital gains because you keep deferring out into 1031s. And you can do that for the rest of your life and never pay anything in taxes.
Okay, cool. All right. Okay, guys, going once, going twice. You got Neal's link, tinyurl.com/chatexp. Neal, I think I speak for a lot of people when I say thanks for doing this again.
Yeah.
Certainly appreciate it, and keep us posted on the book or books. We'd love to be like a test group if you want.
Absolutely.
I do that too whenever I run, and I've written 7 books, and I always give it away free first to all the people that I teach and coach, just to look for feedback or laughs, but what the case is, before I go public with it, and it does help a lot, but we're certainly willing to pay for it when it's ready to come out. Let us know.
Yeah, absolutely. That sounds I actually like that idea a lot. I had just thought to release it on Amazon and just kind of see what happens, but testing groups, that's a much better idea.
Well, what you can do is you can get like testimonials and references, referrals, all kinds of stuff from people. Because a lot of times, if you look at a lot of books, people don't know who they are. Everybody on here is a servant of the community. There's all kinds of accolades they can put out there, awards and stuff like that. But just little one-liner snippets. I mean, I've got literally hundreds and hundreds of them that I pull from time to time. So it's a great way to do that.
Yeah, it's a fantastic idea.
Okay.
So Cindy wants an autographed copy. I will autograph the PDF for you.
There you go. Yeah. Okay, I think we will take an autograph. Oh, that's it. Okay, guys, listen, have an awesome week. We'll see you next Monday again. And next Monday, we'll be going over subject 2 and all kinds of interesting creative purchasing techniques. But Neal, tell Dave I said hi. Well, I'll see him also this week on a one-on-one.
Great.
But hope you and your family doing well, and we'll look forward to the next time.
All right, sounds great.
Okay, guys, take care. We'll see you next week. Let's see.